Good afternoon, I am John Bugeja and I'm the co-founder and managing director of Trade Advisory Network. I'm delighted to have been invited to deliver this closing keynote address today, and I shall be talking about supply chain finance, particularly how supply chain finance can support economic recovery and growth. Now, there has been some confusion and indeed adverse commentary regarding the use or misuse of supply chain finance, particularly following the collapse of Greensill Capital. So I will also try to clarify what supply chain finance is and what it isn't. A couple of years ago, the Global Supply Chain Finance Forum defined supply chain finance quite broadly as a family of techniques for the financing of funding gaps arising from the physical supply chain and related financial supply chain events. Briefly, techniques include receivables finance, inventory finance, pre-shipment finance, and payables finance. Today I will focus on payables finance. All supply chains involve funding gaps as costs are incurred in the sourcing, manufacture and shipment of goods prior to the resulting finished goods being sold and paid for by the buyers. Unless parties have sufficient liquidity to finance these funding gaps themselves, access to supply chain finance is clearly essential to support global trade. Payables finance is a buyer-centric solution in which a buyer is able to enjoy deferred payment terms while enabling their suppliers to get paid early. Characteristics of a successful program include the buyer is a strong credit, typically investment grade. This is, after all, unsecured debt. The suppliers are often much weaker credits, creating an arbitrage opportunity. The finance is priced to reflect the buyer's credit quality, usually a little higher than the buyer would expect to pay for short-term unsecured and committed debt themselves, but considerably lower than the price the suppliers would expect to pay for debt in their own right. Under a payables finance program, the buyer is able to standardize payment terms, which improves the efficiency of the whole accounts payable process. Now, this may involve an element of terms extension, but note that the terms must remain commercially reasonable. In terms of process, the buyer uploads approved invoices onto the bank's platform, or perhaps a third-party platform if applicable, and in doing so makes an unconditional, irrevocable commitment to settle the invoices with the bank at maturity. The suppliers, on the other hand, access the same platform and request that the approved invoice be financed by the bank. In effect, the bank purchases the resulting receivables from the suppliers on a non-recourse basis. The nature of the finance arrangement is arm's length from the buyer, even though the credit risk is on the buyer. This is because the finance request comes from the supplier. This is important from the perspective of accounting treatment, which I'll come on to in a second. This structure, along with the terms remaining commercially reasonable, are important elements for investment grade buyers, as they are necessary for the buyer's auditors to continue to treat obligations as trade creditors in their balance sheet. Note that investment grade buyers in particular do not want to see trade creditors reclassified as bank debt as a result of initiating a payables finance program. In terms of benefits, all parties benefit from a well-structured payables finance program. The supplier's access to finance is not constrained by their own relatively weak balance sheets and their limited availability of tangible security. This enables them to accept increased orders and grow, supporting economic recovery. The cost of this finance is, of course, considerably lower than would otherwise be the case. The buyer continues to enjoy deferred payment terms while supporting their suppliers. Now, this isn't charity on the part of the buyers. It's actually in the buyer's interest to ensure that suppliers do not run out of money. If they were to run out of money, there is a real danger that they fail to deliver essential goods on time, causing major disruption to the buyer's production line and trade cycle. Using a payables finance solution will often enable the buyer to avoid the need to issue letters of credit, as they can continue to operate on open account terms. The bank also benefits. The bank generates a higher level of return against their exposure to the client due to the credit risk arbitrage opportunity. There are, of course, some challenges to overcome with a payables finance program. Onboarding suppliers is a lengthy and difficult process as it involves significant due diligence. The due diligence is required because, in effect, the supplier becomes the bank's client when they sign a receivables purchase agreement. And this is particularly challenging when the suppliers are located in countries where the bank does not have a physical presence. It is possible to address this by collaborating with a partner bank in the countries where the suppliers are located. Should note, however, that this means that the income has to be shared between the two banks. The conversion process itself is very lengthy. For the buyer, this is a strategic decision involving multiple stakeholders, including treasury, procurement, legal, accounting, and so on. So it's not a decision they take quickly. Then the suppliers need to be encouraged to start using the program. So there's actually two sales processes that need to take place sequentially. Getting the suppliers to buy into the concept of the program requires a collaborative effort between the bank and the buyer. And revenue is only generated once the suppliers start to use the program. To be cost effective, most programs as a result concentrate on the top tier of strategic suppliers, leaving what's known as the long tail of smaller suppliers that cannot get access to the payables finance program. Now, an interesting alternative to complement payables finance is to use promissory notes signed by the buyer and guaranteed by the bank, which suppliers can then use to access cost-effective finance locally. Of course, no one wants to revert to paper, but the technology now exists to create and manage digital original documents, including the equivalent of promissory notes. The International Trade and Forfeiting Association, ITFA, has developed and published the required specification, known as the DDoC specification, which defines the criteria for an acceptable digital payment obligation. And I would encourage you to check out their website to learn more about how these obligations work. The law is catching up as more and more countries move towards adopting UNCITRAL's model law on transferable electronic records. In the UK, for example, a bill enabling the Bills of Exchange Act of 1882 to apply to digital prom notes and bills of exchange is expected to be passed by Parliament early next year. In the meantime, a contract-based solution can be adopted. Once the programme has gained traction, of course, the overall exposure can become large, which is good for revenue, but it may be excessive for a single bank. This may mean collaborating with one or more other banks. Probably the best way to achieve this is to work with a third-party platform where various banks can become funders on the same platform, rather than each bank working independently alongside each other with their own platforms. Finally, a word about the Greensill collapse, which caused so much adverse comment about supply chain finance generally. Greensill were financing what they called future receivables. These are not receivables at all, but are an estimation of future sales that might or might not be made by a particular supplier to a particular buyer. And these estimations are made using artificial intelligence and advanced algorithms. Now, there's nothing wrong with using this technology to support lending decisions, but this is not supply chain finance and shouldn't be described as such. To conclude, supply chain finance offers real benefits to suppliers, buyers and banks, and can certainly support economic recovery and growth. It is important to use supply chain finance correctly, not to extend payment terms beyond what is commercially reasonable. And the finance of future receivables is most definitely not supply chain finance. Designing and implementing a successful program requires dedicated resources and significant expertise. As it happens, this is something that we at Trade Advisory Network provide to banks, fintechs and corporates. On that note, let me say thank you for listening to my comments, and I hope that you all enjoyed the event as a whole. Hopefully, next time we will all be able to meet in person.
Thank you very much, sir, for those passionate thoughts that you've shared with us all. And what a befitting end it is to the 8th annual edition of the Supply Chain Management and Logistics Summit 2021. I must admit that we've all managed to gather some very important and interesting takeaways, while I also see that the future looks pretty optimistic, with everybody looking forward to meeting one-on-one, in person. Well, of course, right now we're harnessing the power of technology and telecom, playing the protagonist over here. But I do hope that we all get to catch up in the next edition, of course, one-on-one. While we do that, I'd like to also take the opportunity one last time to also thank our fabulous set of partners for their fabulous support. The entire program that's been presented by the Economic Times, the 8th annual edition, Supply Chain Management and Logistics Summit 2021, powered by All Cargo Logistics and Gati KWE, co-powered by Infor and Mahindra Logistics. Our supply chain technology partner, TruckNet Digital, our technology partner, GEP, associate partners, O9 Solutions, EFL, DB Schenker, Accenture, Shake Deal, and Critical Log. Our knowledge partner, PwC, supporting associations, All India Motor Transport Congress, and Federation of Indian Export Organization. We'd also like to thank our media partners, Indian Transport and Logistics News, eCargo Log, and Cargo Talk. With that, we do come to the end of the summit, the 8th edition of the summit, and I do hope that you're all staying safe and taking care, as it's time for me, Kavya R. Chavli, to sign off. We do have the feedback forms that's available for all of you to please share your feedback about the summit. So all you can do is head towards the lobby and fill in your feedback. We also hope you made the most of the experience zones, connected with all the partners and all the booth representatives, and managed to gather as many insights and as many points possible, which are helpful for your business for that matter. With that, it's time for me to sign off now. It's time to say a goodbye, but most importantly, stay safe and have a happy weekend. Thank you.